Hello and a warm welcome to Personal Finance. I'm Guguletu Cele. Well, last night we took a look at tax-free savings accounts for different ages, and tonight we continue that conversation with Sydney Sekese, a CFP professional representing the FPI. Good to have you with us as always, Sydney. It seems as though this topic keeps on going. Tax-free savings accounts, it's a lot bigger than what we actually understand it to be. But just a quick refresher, and one of the key takeaways that came out from last night's conversation with Dan Meshbana and Bradley from Alex Forbes was that over-contribution is a key consideration to always remember when it comes to tax-free savings accounts. I take it you agree here on this front?
Yes, I agree very much so. And I think what government has identified is that if consumers save a certain amount every month, it will really help in the bigger scheme of things. It will improve the growth of the economy. And obviously, it's a control to ensure that there's a certain level of contribution and savings, and if you over contribute, it also is an awakening factor to ensure that you actually diversify your savings instead of concentrating on the only tax-free savings account. So I think it's another angle of encouraging diversification of saving vehicles.
You mentioned diversification. Yes. I think for the South African consumer, many of them are confused because you've got your banks offering products, you've got your investment houses offering products. There's just a lot of tax-free savings accounts on offer, and one doesn't know how to choose which one is best suited to them. I take it visiting someone like you is the first point of call to identify what your objectives are before putting your money in either of these products. Yeah,
there's always a thin line between saving and investing.
Yes.
Yes. So. And those words are used interchangeably, and saving is really for short-term requirements. Depending on your level of income or even the life stage, you might be a matured adult who's looking forward to sponsoring your daughter for a wedding. So you may want to consider savings instead of investing, because investing is for long term. And again, you can break down investing in terms of medium and long term goals. So again, that diversification of products really tries to distinguish between saving and investing. And again, with the tax-free savings accounts, I think it's a cool way of starting to distinguish between saving and investment. So a certified financial planner or any financial advisor would really have to identify and distinguish between savings accounts for their clients and investment accounts. And if there's any rebalancing that is required, then they might want to tap into tax-free savings accounts to boost savings element, or if there's a shortfall in investments, they may also consider other investment vehicles.
So understanding the products that are available, and more importantly the investment objective, whether you're saving or you're investing, obviously looks at the long-term perspective. So if you're going to invest in a tax-free savings account, are we looking at something long-term here, or look at some of the other short-term products that might be available, like your usual banking deposits that have 24-hour notifications and accessibility?
Yeah, it's horses for courses, depending on your term of investing or term of savings. I think I listened last night when they spoke about tax-free savings. It's ideally long-term, and really for young adults. For an example, calculations have been made that for a 25-year-old who invests in an interest-bearing savings account, by the age of 65, she or he can expect to have accumulated 1.5 million.
Based on how much their monthly contribution is, would that be 100 Rand?
Yeah, assuming around 100 or 200 bucks, they would expect that to have grown to that level. This is assuming an interest-bearing savings account. Now, with a tax-free element, or the tax-free savings account that has been introduced, that can almost double to close to 2.7 million. So there are really incentives for young investors to consider starting immediately to benefit in the long term. So depending on your lifespan and your needs, tax-free savings can meet any objective depending on your requirements.
I want us to get into the element of children, because
Yes.
sometimes as adults and individuals we fail to save enough money for ourselves and actually fall short as well with providing some kind of savings means for our children. Is a tax-free saving account a good place to start for anyone who has young children? Open up a tax-free savings investment account for them and leave it for the long term. Maybe you'll use it for university fees, or it's a nice startup for when they finish university and need a car. Should parents be thinking that way who are watching this evening?
Yeah, it's a prudent way to actually open a savings account in their names. And if you've got 4 kids, you can have 120,000 invested each year. And again, the compound interest will really benefit them. It's almost like free lunch, you know.
Exactly.
And again, you know, with government providing those kind of incentives, it's a prudent way of again, if we have to define savings, savings is really putting away money, you know, to purchase future needs. And again, having accumulated that much amount of money provides some form of financial independence. So again, these savings vehicles, tax-free savings accounts, really at the end of the day, they provide that financial independence, and the government would be very happy if most of us are financially independent.
Exactly.
And as you may be aware, research has shown that you know, people, less than 6% of people will retire independently. And I think the savings account go a long way in improving financial independence of South Africans.
Which is what we want for the long term. Sydney, something that also confuses some viewers is the product offerings from different providers. You mentioned, obviously, look at your investment strategy or saving strategy as to what kind of exposure or return you're looking for. But is it advisable to take out one tax-free savings product with one provider and cap that 30,000 limit, which they will monitor for you, or take out one with different facilities and bankings, institutions, or even other financial institutions that you might be affiliated with? Does it make it more difficult then to monitor the limit on the yearly contributions?
Yeah, again, it's, you know, when these tax-free savings accounts were launched, the idea came along the plethora of investment products that are available in the industry. And a consumer is usually confused in terms of all these choices. So if you're going to break down the savings accounts into different investment houses, it becomes very cumbersome in terms of consolidating your financial affairs, and it makes sense to really consolidate with one service provider. And again, they can easily flag if you over-contribute.
Exactly,
Yeah.
which would put you at risk for actually paying tax on some of the growth there.
And you know, if you over-contribute, you know, you pay a marginal tax of more than 40%, which is a disincentive. So you actually negate what you started before.
Exactly. Another big element that comes into play has to be costs, because fundamentally these financial houses aren't doing this for free. Is that also something that a lot of viewers need to monitor? Yes,
they need to monitor, and the trend is, you know, depending on your risk appetite as an investor, the costs, they range between 0.4% per annum to 1%. 0.4 is for a conservative investor who doesn't like the volatility or the highs and lows of the investments, and 1% would be for the high risk taker who would invest fully into equities or shares, and again, that is also a consideration if you have to enter into those kind of schemes.
Exactly.
Yes.
Sydney, just before we wrap up this conversation, should those who have additional funds available and don't want to be at risk of over-contributing then be looking at other products like your unit trusts, which aren't necessarily tax-free, or other ETFs or other forms of investment to take that extra money that they haven't put in a tax-free savings account and invest that even further as well, in maybe something that's slightly more aggressive or more in line with their path to wealth creation?
Yeah, I've got a philosophy just to assist the consumers, which is a 5-step consideration. The first step is to reduce debt.
Yep.
and secondly is really to create an emergency fund. Third step is to you know, contribute maximum or to benefit in the maximum tax deduction offered by retirement annuities. And the fourth step is to tap into the tax-free savings at 30,000 level. And fifthly, use the discretionary surplus that you might have to invest in shares, ETFs, unit trusts. So those cosmetics or luxurious investment vehicles should be considered once the first four items have been taken care of. It doesn't help to tap into ETFs or shares when you're still in debt. So the first thing is to reduce your debt and consider all the tax-free or the tax incentives that are currently in place. And any surplus funds you can invest in those exotic investments.
Well, let's recap on this discussion before we move to exotic investments. But Sydney, just to wrap everything up with regard to tax-free savings accounts, it's a lot for individuals to consider. But like you say, first step is speak to a financial planner. Sure. And determine your objectives. Sure.
There's also a mantra that consumers can use. And that mantra says, save a little bit each month. And at the end of 12 months, you realize how little you have really saved. What it means every year you will be able to save. So that mantra will help you to realize after 12 months, you realize how little you've saved, then you'll be encouraged to save even more. So I think it's a prudent way of really having that savings culture and also avoiding the short-term mentality of instant gratification.
Exactly, and understand the products that you want to save and invest in, as you've already mentioned.
Yes, very much so.
Sydney, thank you so much for your time this evening. Always a pleasure speaking to you. Well, that's where we leave it for Personal Finance tonight. A big thank you once more to Sydney Sekese, a CFP professional, joining us this evening. Remember that we'd love to hear from you, so you can tweet any of your comments or suggestions to @CNBC Africa using the hashtag Finance410 or to myself @Kukumfupi on Twitter. Until next time, it's goodbye for now.